In this video, I'll be revealing the precise timing strategies that smart retirees use for Roth conversions and why knowing when to convert can save you tens of thousands in taxes over retirement. Through working with countless retirees who've mastered the timing of Roth conversions, I've discovered that the difference between random conversions and strategic timing often determines whether you build tax-free wealth or pay unnecessary taxes for decades. And that's exactly why I'm making this video, to show you the specific timing signals that indicate when Roth conversions make financial sense and when they could cost you money. Now, for most people, when you step into retirement, you're often in the lowest income tax bracket that you've sniffed out for decades. And at the same time, you have a large bucket of oftentimes pre-tax money that you're trying to figure out how to pay yourself with in the most tax-efficient manner, not just for today, but throughout the rest of your retirement. And that's exactly why I want to show you how to take advantage of managing your tax brackets through strategic conversions. If you manage your tax brackets well, you'll have ample opportunity to do conversions in the early years. And even better, if you have taxable money set aside in cash to pay for those conversions, that can amplify the strategy even more. Now, even if you don't have a large chunk of taxable money set aside, you will have an opportunity to do conversions at a lower tax bracket compared to what your required distributions will force you in later in retirement, especially if today you have a good amount of pre-tax money and don't intend to spend all that much above Social Security in your earlier years. Now, one of my favorite strategies we'll cover in more detail later in this video, but it's delaying Social Security for a handful of years. And if you build up the after-tax cash in a brokerage account, you can use that to live off of, pay for the conversions from, and keep that tax bracket lower for longer. And delaying Social Security gives you the opportunity to spread out your conversions across multiple years. For example, if you retire at age 60, you then have 15 years to do conversions and at least 6 to 10 years before you ideally will take Social Security. Even if you are taking Social Security, you can still do conversions. Just make sure that you keep the extra income in mind when you're calculating your expected taxes. In your early retirement years, you can take advantage of filling up certain tax brackets. The longer your window for conversions, the more flexible you can be with converting, and you can decide which tax bracket that you fill up and how long you have to knock out those upcoming unnecessary RMDs or do so for legacy purposes. But here's why managing your tax bracket can be just as important as the conversion amount itself. A lot of times, I'll see retirees choose a certain dollar amount to do conversions on. And while that's not the worst thing to do, it doesn't really make sense when you're talking about what we're trying to accomplish with a conversion. Because the impact of your conversion can be boiled down to the simplest level of, are we paying taxes at a higher rate now, or will we pay taxes at a higher rate later? Whether that's yourself when you're taking RMDs, or your children when you pass this money on to them after you go. The simplest way to compare and decide if a conversion makes sense is if you're projected to be in a higher tax bracket now or later. But like I always say, we don't want to make any financial decisions in a silo because there's more to it than that. You have to consider things like IRMA. You have to consider when you take Social Security, and if you've retired before age 65, tax subsidies on your marketplace health plan. And a quick way to determine if you should do the conversion is if you're being taxed, for example, at 24% now and project to be taxed at 12% later, then it may make sense to not even do a conversion at all. However, on the flip side, if you're projected to be in a 12% tax bracket now and a 24% tax bracket later because of RMDs, or if your spouse has some sort of illness or is much older than you, and you may be likely to file single, well, then there could be a lot of really compelling reasons to do a conversion earlier on. Now, obviously, if you're paying these taxes from cash outside of the conversion itself, your conversion will have a higher impact on your overall situation. But even if you're paying it from the conversion itself, there's still going to be a break-even point. Often, it's in your 80s or even your 90s. If you pay for the taxes out of the conversion itself and the tax savings from the conversion, assuming you would have been in a higher tax bracket later due to RMDs, also have compounding effects too. So it's no secret that tax bracket timing can help maximize the value of the conversion, but the RMD avoidance strategy shows another powerful benefit to strategic conversions. That's why a primary objective of our Roth conversion strategies is to avoid those unnecessary RMDs. See, if we could project that your spending will lag behind the required distributions that you'll need to take into your 70s and beyond, then it makes more sense to do conversions if those will inevitably be pushing you into a higher and higher tax bracket. Now, there are other ways to solve that problem, like QCDs, or what's called qualifying charitable distributions, which you're eligible for after age 70 and a half. But if we see distributions exceeding your desired spending, then that's a pretty good indicator that we should think about this earlier with some conversions. The other thing about RMDs is that the percent you need to take out each year actually goes up over time, meaning that percentage that you'll need to take at 85 is much greater than the percentage that you'll need to take out at age 75. That's because your required distributions are based on life expectancy, and that percentage will continue to grow throughout retirement. That means at the precise phase of life when you're generally doing less spending, other than maybe healthcare or long-term care costs, you're forced to take out even more from their portfolio than ever before. That's why it's so important to take advantage of time when you have it. And applies to more things in life than just conversions, but especially in this case as well. That's why by implementing a proactive plan for conversions earlier in your retirement, it can help you avoid the escalating tax issue that can come with required distributions later on in life. And if all else is equal, it gives you more control over the controllables later on and allows you to, well, avoid some of the stress that comes with that. Now, RMD avoidance provides long-term benefits, but the 5-year timing rule shows when conversions can backfire if you're not prepared for it. That's why you need to be careful about the timing of these conversions in relation to when you take the money out. Most of the time for our clients, we're doing conversions from a pre-tax to a Roth, and we're allowing those funds to grow for some time. But there are situations where you may need to access your Roth dollars after converting them. And you need to be careful if that time period is going to be within a 5-year window, because there's some rules that you want to make sure that you follow. Here's the rules that you need to be aware of, and most importantly, here's how they work. Any contributions that you have made to a Roth directly at any time can be taken out tax and penalty free. And if you're over 59 and a half or 5 years out from the conversion, you can take your contributions out tax and penalty free. That is the first leg of what's called the 5-year rule. This means that any conversion you've made 5 years or more prior, or if you're 59 and a half and any conversions you've made at any time can be taken out tax free. The next thing to be aware of is how it works for earnings, and this is what catches most people off guard. What you need to know about the earnings rule is this. If you are 5 years out from the conversion and over 59 and a half, there's no tax or penalties on that conversion. If you're over 59 and a half, but the conversion was done only 3 years ago, then those earnings will be taxed. That's why knowing these rules can keep you from making a mistake on the timing of Roth conversions and your distributions. Now, you shouldn't really run into this because most of the time we're prepping this with clients. We're converting for a long-term strategy and not necessarily planning to take funds out of their Roth in a significant way, at least for quite some time. But life happens. Otherwise, the Roth conversion might not actually make sense since you're paying taxes up front and running into one of these hurdles. That's why it's important to know the rules. And if you're wondering how to time your conversions perfectly for your situation, click the link below to book a call, and I'll be happy to analyze your specific circumstances to help you create the optimal conversion strategy. And speaking of strategy, let's talk about one of my favorite ones, what I like to call the sweet spot for converting. As I mentioned before, one of the best pieces of this strategy can be executed in the window between the time you retire and when you claim Social Security. This is because your income is lower in those years, especially if you have those after-tax assets that we talked about. The reason I love this so much is that it gives you the opportunity to strategically control how much income you're taking each and every year, converting up to a certain tax bracket and allowing you to convert quite a bit more within that same tax bracket because you have more room on top of it. And the lower income that you'll have during those years gives you the ability to convert $50,000 to $60,000 per year while only paying 10 to 12% top marginal tax rates in many cases. Ideally, your early retirement strategy is structured around this window of opportunity to make strategic conversions and pay less in taxes over time. And if you have a good deal of pre-tax assets, that time is going to become all the more important. So it's clear that taking advantage of income gaps can create opportunities if you're strategic, but the tax diversification benefit shows why conversions matter regardless of timing. Ignoring this one thing is where a lot of people leave money on the table when they do their conversions, and here's how you can avoid doing the same. You see, it's not always wise to do a Roth conversion and then just leave the money in the same investments. This can actually be a massive mistake that can eliminate one of the key benefits that you get from converting in the first place, which is tax-free growth. Now, it may seem like a no-brainer, but here's why this matters. Many people just pay taxes upfront to get money from a pre-tax to a tax-free growth environment, and then they're turning around and putting them in low-growth investments like bonds. That's why the importance of tax location among your holdings cannot be overstated. It's important to maximize these benefits that you get from tax-free growth. This can vary, but in my opinion, high level, here's what the optimal allocation strategy could look like. You want your high-growth assets in your Roth IRAs. You want maximum tax-free growth on your highest returning investments. Conversely, you want your lower growth assets like bonds, for example. Those should be in your pre-tax IRAs. You'll pay taxes on these anyway, so it's better to put the lower growth stuff in this bucket. And lastly, you want your tax-efficient investments in your taxable accounts, things like municipal bonds, index funds with low turnover, etc. And it may seem simple, but having a strategic asset location like this can add hundreds of thousands to your long-term wealth. But most people completely ignore it, and that's why they're leaving money on the table. So how do you figure out whether conversion is right or not? One of the things we often say is conversions are not a set it and forget it type of strategy. It's something that needs to be recalculated every single year based on your income, your potential claiming of Social Security, and other sources of income like investment income, pensions, etc. That's why it's important for each year, towards the end of the year, you want to calculate how much income has come to you throughout the year and where that is in relation to your tax bracket. You'll want to consider whether your top marginal rate that you're trying to fill up is at a higher or lower level than you expect it to be in future years. And conversions are often planned around significant life changes or transitions into retirement. Things like changes to income, changes to your spouse's income, retirement dates, Social Security benefit claim dates, Medicare or health insurance needs, and especially the market experiencing a decline, which I like to call converting on sale. So now that you understand exactly when smart retirees do Roth conversions and how strategic timing can save you tens of thousands in taxes, you can implement conversion strategies that will help you build tax-free wealth rather than paying those unnecessary taxes along the way. And if you want help developing the optimal Roth conversion timing strategy for your specific situation and retirement timeline, then click the link down below to book a call, and I'll be happy to analyze your circumstances to help you create a personalized conversion plan that maximizes value while minimizing taxes. Thanks for watching. I'm Kyle Kuyat, and I'll see you in the next video.